Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Franklin Resources, Inc. quarterly report. Franklin Resources, Inc. is a leading asset investment manager that provides a wide range of services to various clients. The company offers its expertise to individuals, institutions, pension plans, trusts, and partnerships through its subsidiaries. These services include launching equity, fixed income, balanced, and multi-asset mutual funds. The firm's investment portfolio spans across public equity, fixed income, and alternative markets, making it a comprehensive provider of financial solutions. With a global presence in multiple locations, Franklin Resources, Inc. is well-positioned to cater to the diverse needs of its clients worldwide. Franklin Resources, Inc. (BEN) has experienced a significant stock price increase of 34.55% in the past year, with its 52-week low at $16.25 and its 52-week high reaching $27.20. Several key news events contributed to this rise between February 3, 2025 and February 3, 2026. The company's strong fiscal first quarter 2026 results were a major contributor to the stock price increase. Franklin Resources announced adjusted earnings of $0.70 per share, surpassing the Zacks consensus estimate of $0.55 per share. The company also reported an improved assets under management (AUM) balance of $1.68 trillion, up 1.4% sequentially. In addition to the strong fiscal first quarter results, Franklin Resources' positive net inflows and AUM growth in CONE fiscal 2026 were significant factors. Management highlighted record long-term inflows of $118.6 billion, a 40% increase from the prior quarter and 22% from the prior year quarter. Analyst price target increases also played a role in the stock price rise. Several firms raised their price targets for Franklin Resources, including Barclays and Evercore ISI Group, which likely provided positive sentiment to the market. The company's Q4 fiscal 2025 earnings beat was another key event that contributed to the stock price increase. Franklin Resources reported fiscal Q4 2025 EPS of $0.67, exceeding the forecast of $0.5766, and revenue of $1.82 billion, above the expected $1.72 billion. Overall, these events, particularly the robust earnings reports and sustained positive net inflows, contributed to the increase in Franklin Resources, Inc. stock price over the past year. Franklin Resources, Inc. market capitalization of $14 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Franklin Resources, Inc. holds a significant advantage in their industry. Franklin Resources, Inc. trades at a higher price-to-earnings ratio of 24 times and a higher price-to-book ratio of 1.14 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 56% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 5%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of various financial metrics and industry trends. On the growth side, investment management fees saw a significant increase of $48.6 million, while sales and distribution fees rose by $13.2 million. Shareholder servicing fees also experienced a notable surge of $7.4 million. Additionally, other revenue streams such as equity AUM growth, cash management AUM growth, and multi-asset AUM growth contributed to the overall increase in revenue. Furthermore, long-term net flows saw 12.5% growth, indicating an influx of new investments into existing products. Investment management fees also experienced a 3% increase, further boosting revenue. On the other hand, sales and distribution fees declined by 0.6%, while shareholder servicing fees dropped by 12.2%. The net market change, distributions, and other category saw a significant decline of 52.9%. The level and relative mix of assets under management, AUM, also played a crucial role in driving revenue growth or decline. Fees charged for services based on contracts with funds and customers, fund sales, and shareholder transactions and accounts were also key drivers. Investment performance of products and the quality of service to clients further influenced revenue outcomes. Net income and profit margins experienced significant changes between 2024 and 2025. The net income increased by $114.7 million, a substantial 49.6% rise from $232.1 million in 2024 to $346.8 million in 2025. This increase was largely driven by lower losses on investments and higher deferred income taxes. Specifically, the company reported a decrease in investment losses of $48.5 million and an increase in deferred income taxes of $61.5 million. The operating income also saw a notable increase, rising by $62 million, or 28.3% from $219 million in 2024 to $281 million in 2025. This growth was accompanied by a significant improvement in net income margin, which increased by 4.8 percentage points from 10.3% in 2024 to 15.1% in 2025. The decrease in amortization of intangible assets by $55.1 million from $112.6 million in 2024 to $57.5 million in 2025 was another contributing factor to the increase in net income and profit margins. Overall, these changes indicate a positive trend for Franklin Resources, Inc., with improved financial performance across various metrics. The company's financial performance indicates a significant issue with its operating cash flow. The data from page 6 shows that the company has been consistently generating negative operating cash flow over the past 2 years. In 2025, the net cash used in operating activities was -$255.1 million, while in 2024 it was -$145.2 million. This trend is further confirmed by the operating cash flows on page 33, which also show a negative figure of -$255 million, $100,000 for 2025, and -$145 million, $200,000 for 2024. This persistent negative operating cash flow suggests that the company's operations are not generating sufficient funds to cover its expenses. As a result, the company is relying on other sources of funding or using existing resources to meet its financial obligations. This situation may indicate underlying issues with the company's business model, management, or operational efficiency that need to be addressed to improve its financial performance and generate positive operating cash flow in the future. The company's interest expenses have decreased significantly from $23,100,000 in 2024 to $20,400,000 in 2025. However, there is a discrepancy in the company's debt level over the same period. According to the data, the debt level increased from $9,937,300,000 on September 30, 2025 to $10,862,700,000 on December 31, 2025. But it is also mentioned that there was a decrease of $4.7 million in the debt level between these two dates, which seems contradictory. Despite this inconsistency, one clear trend is evident. The company's total aggregate commitments under credit agreement have increased by $400 million to $1.5 billion. This suggests that the company has taken on more debt obligations over time. Overall, while there may be some discrepancies in the data, it appears that the company's debt level and interest expenses have undergone significant changes in recent years. Management's primary focus remains on delivering high-quality service to clients while maintaining strong investment performance. To achieve this, they will prioritize expense management alongside strategic investments in personnel, systems, and technology to support growth. The company aims to protect and enhance its brand recognition through targeted investments and relationship-building efforts. Management is also prepared for the challenges posed by a complex global economic environment. In terms of growth strategy, the company plans to continue investing in acquisitions and utilizing post-dividend free cash flow for business investments. Additionally, management intends to opportunistically repurchase shares from time to time to maximize shareholder value. Regular quarterly dividends are expected to remain comparable to previous levels. The company's financial performance is reflected in its dividend and share buyback policies. In terms of dividend payments, the company has a history of paying dividends to its shareholders. Specifically, it declared regular dividends of $0.33 per share for the 3 months ended December 31, 2025. In addition to paying dividends, the company has also engaged in share buybacks. This indicates that management is confident in the company's financial position and believes that repurchasing shares will benefit shareholders by increasing earnings per share. The multiple pages confirming share buyback activities demonstrate a consistent effort to return value to investors through this means. There are some concerns about supply chain disruption, but they do not appear to be directly linked to inventory buildup. A possible indication of this is the mention of lower inflows in equity sub-advised mutual funds and slightly higher outflows in fixed income vehicles on page 24. However, no specific information about inventory levels or direct concerns about supply chain disruption are mentioned elsewhere in the text. That concludes the financial summary for Franklin Resources, Inc. Feel free to comment below, and I will be happy to answer them when possible.